Hi everyone, thanks for turning up today and joining. I'm just going to give it a minute or so just to let any latecomers or um, people just getting off other things from 12 to join us. So give us 30 seconds or so and then we'll make a start. All right. In the interest of time, I will we'll get started. So yeah, again, thanks very much for coming along. Hopefully you get something out of this. Just to before we start, I just want to take the opportunity, rather than do it at the end, just to for all our clients on the line, I just really want to thank you for the opportunity that we've had to work with you over the last 12 months, and also friends and contacts. Also really appreciate the opportunity to share these sort of things with you. And as we lead into Christmas and the break, just want to wish everyone a really Merry Christmas and hope you get a restful and enjoyable New Year. During today, we'll record the session, so that will get sent out afterwards. Behind the scenes, Edward Jones, one of the directors here, will answer any questions you have. So please put your questions in the Q&A and take the opportunity to get some free advice while I work my way through the slides. So if there's any themes or anything like that coming out of the Q&A, Edward will jump in at the end. But otherwise, yeah, take your opportunity to get some really specific answers to if you've got more specific questions on any of the content today. All right, so we'll kick off the presentation. Hopefully I can move my slides. So the agenda for today, we'll just do a few reminders, and these are sort of common areas that we see where clients perhaps don't think about some of these issues, or common places where we've got some errors and we're doing updates on. So just give some reminders around that. I'll touch on what the regulators are up to, ASIC, ACNC, etc. IFRS 18 is a new standard that's coming down the line, and so I'll give you an update on that. After that, I'll go to special purpose and tier 3, which is purely for not-for-profits. So if you're a for-profit in the room and you want to duck out after we get through IFRS 18, please feel free to do so. And then at the end, I'll just touch briefly on sustainability as well, and give you an update of where that's at. Again, that'll apply mainly to for-profits. So if you happy to hang around and see that, but it's not an in-depth level of information around sustainability. It's really just an overview of where we sit in that process at the moment. All right, so I'll jump straight in, kicking off a few reminders. This assumes you're following the accounting standards. So if you're a special purpose reporter, don't follow accounting standards. I'm focusing on what the accounting standards say in this space, but really areas where, again, we see our clients maybe not quite be across the nuance, and places where we often step in and do some recalcs, etc. So the first one I just want to touch on in leases, which is everyone's least favourite standard. Well, it's mine anyway. And so what we see is, as leases have been implemented for a number of years now, as organisations renegotiate leases or lease renewals, just wanted to remind that where you lease the same property, that under the accounting standard is what's called a lease modification and not a new lease. That means that when you enter into the renegotiation or enter into a new agreement, it's in effect a continuation of the existing agreement. So if you do that 6 months out from your first agreement coming to an end, you do the recalculation at that point where you enter into the new agreement. And so if what we see often is a new agreement's been entered into, but the period of that new agreement doesn't start till post year end. And we have to pick up that uplift in right of use asset lease liability and change the calculations that impact the P&L as well for when that agreement was entered into. So that's just something to be mindful, particularly if you have a lot of leases, to be across that issue. The second one's revenue recognition. If you've been coming to these, one of our clients, you'll hear us talk about revenue recognition a lot. Just a reminder that revenue is recognised under AASB 15. You recognise revenue in a way or in a method that shows or demonstrates the transfer of goods or services to the customer. And so that's the underlying principle of that standard. And we still see some confusion around that, issues around that, where you've got a complex grant agreement or something like that. Sometimes it's difficult to interpret exactly how or which options you validly have under that agreement for recognising revenue. But I would just note, don't just assume you can recognise revenue as costs are incurred. So we still see that as, I guess, what a lot of particularly not-for-profits want to do as a default and understand, so that's matching and those sort of things. But the standard doesn't always allow that. And so you still need to work your way through individual agreements to understand and record revenue appropriately in accordance with the standard. Next one I just wanted to touch on was intangibles. And so sorry, I skipped a slide there. I'll just jump back. So for revenue recognition, assess the contract at the beginning. If you've got a lot of grant agreements or different revenue streams, we'd suggest some sort of matrix or summary page. And sometimes that means you need to get information from operational staff. So again, just reinforcing, understanding the terms and conditions of those underlying funding agreements is really important to getting to the right spot as far as revenue recognition goes. Finally, just want to touch on intangibles and software as a service. We're seeing more and more finance systems, CRMs, etc., are cloud-based and where you pay some sort of monthly or fee to utilize that software. Just want to remind you that as you go through the process of potentially implementing either new accounting software, CRM, that if it's a software as a service arrangement, so that cloud-based monthly fee type arrangement, it's quite likely that your implementation costs are an expense as opposed to a capitalization and some sort of amortization over a period of time. The reason is that the standard really hangs on, do you have the ability to control and exploit the underlying code, as opposed to a concept of just being able to have intent to continue to use a piece of software that you're licensing. And so that's that can result in sort of some big expense items for organisations that go through a software update or something like that. So just want to remind you of that. If you're doing budgets and you've got software sort of plans or strategic plans to change software systems or do major upgrades or something like that, just to consider that issue up front, so to avoid sort of those surprises later on around that accounting treatment. So they're probably some of the really common things that we see. Next, I want to just jump into the regulator update and really just what the regulators are focusing and what they're up to. So I'll start with ASIC. So if you lodge reports with ASIC, that might mean you're a proprietary limited company, an overseas subsidiary, or for example, you're a company limited by guarantee that's not an ACNC charity. You'll be required to lodge financial statements with ASIC. They put out focus areas. Often they're very similar year on year. They're certainly focused again on revenue recognition, making sure you got it not only in the right period, but they're also have you got legal entitlement around revenue. They also look at asset valuations, impairments, particularly around things like intangibles or goodwill, subsequent events, consolidation. So consolidation continues to be an issue. What we've seen is as special purposes has been removed for for-profits and grandfathering and some of those non-lodgement type exemptions have been removed. ASIC has, in their reviews, have identified areas where control does exist, even though it might not be just through shareholding or something like that, which is what we typically see, and consolidated accounts haven't been prepared. So they continue to focus on that, and as well as disaggregation of disclosures, particularly around key things like financial instruments, revenue recognition, etc. We would say that if you have complexity or judgment, having a position paper or some level of technical analysis with a conclusion is the best approach in relation to working your way through complex accounting issues and determining an appropriate treatment. That can then easily be reviewed by the auditor, the finance committee or board, and those sort of things. I would just note that ASIC is also very much ramping up its focus on lodgement and late lodgement of financial statements or non-lodgement. And so again, if you're required to lodge financial reports with ASIC, it's really important that your year-end timeframe schedule fits in with your lodgement requirement, typically 4 months after year-end. There is often a bit of a grace period beyond that where the late lodgement fee is very, very minor. But within a month of that sort of date, if you're pushing out or your board meetings or whatever extend beyond that, I would suggest you reconsider that. So I'm only talking about ASIC lodgements here, not ACNC, many of those type of entities on the call. So that's what ASIC are up to. To flick over to the ACNC, just note that they've released their findings around financial reports. The last lot they looked at were 23. They pull out a sample and do analysis. And overall, they found that 57% of charities had some sort of what they've called material error in the reporting. Now, when they say reporting, they mean AIS and the financial report. So they're looking at both those documents, and they're looking at consistency between. So one, your financial statements may have been absolutely correct, but the AIS has a conflicting or something that doesn't align, and therefore they're saying there's a material error. But that's still quite a big amount. In relation to what they're specifically looking at, they looked at very much around key management personnel remuneration, which was a required disclosure that came in a couple of years ago, even for special purpose. So looked at large charities being revenue over 3 million charities, so not necessarily large, but that threshold. So they found errors in key management personnel, and they continue to look at that, and then related party disclosures as per the bottom line. 82% they said had no issues. That still means there was 18% that had differences there between the financial report and the AIS around this related party key management personnel issue. So again, something to be mindful of. We've talked before about what you should do around capturing related parties, policies, some sort of register of related parties to enable the finance team to ensure they capture all those types of transactions and they find their way into your financial report. So that's really the two regulators that I wanted to touch on and just talk about those sort of things. Next, I'll jump into IFRS 18. So this has got a little bit of a lead time, but I really want to touch on it due to the level of change and some thought that might be required as IFRS 18 comes in. So first of all, IFRS 18, it's in effect will be the foundational standard going forward. It replaces AASB 101. So the key concepts around, or the key new concepts, if you like, being introduced under IFRS 18 is the structure of the statement of profit and loss will change. And I'll go through an example. There's really additional disclosures around profit and loss performance measures. So if you're an organisation that likes to disclose some other type of performance measure, so think EBIT, EBITDA, or something else that's really relevant to your industry or your financial report, They're called management-defined performance measures within this standard. And they've put some real boundary and guardrails around those, really around consistency and explanation as to why it's an applicable measure to think about. And then there's enhanced principles on when you aggregate versus when you disaggregate in the primary financial statements, being the profit and loss balance sheet, and in the notes as well. So that's the core that's being done. I'm not going to go into the details around disaggregation and some of those things. Next year, in the updates, I'll start to break this standard down a bit for you because it becomes applicable from 1 January 27. And of periods beginning on or after, and not-for-profits a year later. So we've still got some time before we're in the comparative period, but I will ensure that we'll give you information around that in the lead up. So jumping on from that, here's what the standard will talk about. Here's what the new income statement or profit and loss will look like. So you'll see that it's broken down into categories that look a lot like a cash flow statement. So at the top, we have some operating activities where your core revenue, all your normal expenses, either by function or nature, which is what AASB 101 has at the moment, although it allows for a mix where appropriate, which is interesting. The next section would be investing. So that's profit and loss style investing activities. So that would be income from investments, share of profit and loss if you're equity accounting, fair value movements, and those type of things, interest income, so interest dividend income, that sort of stuff. And then the third section is financing. So it's going to be interest expense, either from borrowings, leases, and that type of nature. Brings you down to a profit line, then tax, and then therefore profit after tax line. So you would note that if you're up at operating, you've got this operating profit line. If you then take investing, so operating profit after, and so profit before financing in income tax, that's EBIT. So we start to get some of those measures pulled in. We don't get EBITDA. Depreciation will sit up in operating, but the rest is broken down in that way. I would just like to note that as you work your way through this or think about this, the categories may have the same label as the cash flow, but they're not the same. In that, if you think about investing from P&L is going to be dividend income, interest income, other income from investments, whereas investing from a cash flow perspective is investing in things like property, plant, and equipment. But depreciation from property, plant, and equipment is in operating. So you don't get this clear alignment between the P&L and the cash flow. And so you just should be aware of that. I would note that if you've got a really complex entity, a lot of financial instruments, for example, other complexity within your entity, this standard does become more complex. Again, I'll start to unpack some of those things in future sessions as again, implementation gets closer. I think for many people on the call, you're probably either doing special purpose or you're in the simplified disclosure, general purpose simplified disclosure, which is both for-profit and not-for-profit, get to use SDS under AASB 1060. So AASB 1060 hasn't been updated. I know some, particularly not-for-profits, are quite attracted to that new P&L format. They really want to split out their investing and financing type revenue and expenses to give or demonstrate what they would think about as their underlying profitability would be when you exclude those types of items. If you're doing SDS, you can't do that yet. So early adoption is not available of that format until the Accounting Standards Board updates 1060. So they're currently in a process of having a think about that and doing some consultation around what other disclosures. I think the formats will come in under 1060. The level of other disclosures that 1060 picks up from IFRS 18 is really what that consultation is about. And again, as that happens, for SDS reporters. I'll keep you updated over the next 6 to 12 months. I expect that we'll get some answers on that one. All right, so that's IFRS 18, and I'm just going to grab a clock that's a bit closer to me so I can see. I'm now going to just jump to special purpose tier 3. So again, this is not-for-profit specific. So if you're a for-profit on the room, you can probably look away and do something else for 10 or 15 before I get to sustainability, but or jump off. And if you do that, there's no judgment. Really appreciate you turning up for the other bits. But yeah, purely not-for-profit is the next section. So a bit of background: special purpose reporting is something is unique to Australia. No other jurisdiction really has it, where you can lodge in effect a set of financials where you've got quite a deal of variability and choice in what you do and how you prepare your financial statements. The Accounting Standards Board decided this was not a great idea, and in principle that makes sense. And so they commenced a project 10 years ago now around the removal of special purpose. So discussion papers, etc. They did a whole lot of research. Discussion papers in 2022 around tier 3. Exposure draft came out last year. That really is an exposure draft is just, here's what we're thinking, give us all your feedback. And we expect to get a final standard in the first half of next year with an effective date from 1 July 2029, but with early adoption. And I think early adoption will be quite attractive to a lot of not-for-profits, particularly the smaller end, where this standard will make far more sense to them. So I've been involved with the Accounting Standards Board throughout this project. I've been on one of the advisory panels around it. So since 2022 and before, I've been involved with the AASB around this. And my own view is I think the AASB has actually done a really good job and got to some quite pragmatic available treatments under this new standard. And so it's a lot simpler. It's a lot easier to read, and I expect it'll be really popular amongst smaller end charities. I would note that for-profit special purpose went in 2021. So if you're lodging with ASIC and you think you can still do a special purpose report, you're a fair way behind. You need to get up to date on that sort of thing. Likewise, if you're moving towards a for-profit, moving towards the thresholds where you need to report, you need to become a general purpose reporter if you end up in a position where you need to lodge with ASIC. So what happened was these 2 exposure drafts were issued. One removes the ability to undertake special purpose. The other introduces tier 3, which is this simplified standard. The objective of tier 3 was to reduce the reporting burden on smaller not-for-profits. There was recognition that, in effect, IFRS-style accounting standards are overly onerous and overly complex for smaller charities and not-for-profits. And I think that's true. And so that's where the concept of tier 3 came from. I would note that New Zealand has got tiers of accounting in the not-for-profit space, etc. So we're not out on our own in Australia, sort of developing that type of thing. Likewise, even there's an accounting standard IFRS for SMEs, never adopted in Australia, but it's a lower level or appropriate accounting standards for less complex or smaller entities. So even at the IFRS level, there's that sort of concept. The big unknown at the moment is who gets to apply tier 3. So again, it's the whole private and not-for-profit private sector space. So it's not just ACNC charities. It should be available for companies limited by guarantee, for example, sporting organisations, that type of thing that aren't an ACNC charity, but are still a not-for-profit for reporting. Likewise, incorporated associations, member-based bodies that are not charities will also be able to, it's expected they'll also be able to access this standard. When the tier 3 was designed, it was designed with at the medium ACNC charity level, which is revenue less than $3 million. I think there's been a lot of discussion around that, certainly in the exposure drafts. There were questions around who do you think it should apply to. The CAANZ, so Chartered Accounting Peak Body, they submitted that they think it should be at least 5 million. I would tend to agree. I think it's a standard that could well be and appropriately be applied to a threshold above 3. So what do we know? Not a lot. I know that it's on Treasury's agenda to consider the issue, and they will be who changes in effect the Corps Act and the ACNC Act around ACNC companies that will go guarantee. It'll be the state-based legislating people who actually set the thresholds, but I assume they'll fall into line because there is a reasonable amount of alignment around between federal state thresholds at the moment around reporting. I would suggest that if you're a charity, a not-for-profit with less than 3 million, it's highly likely you will get to apply Tier 3. I would suggest that if you've got revenue over 10 million, you're probably on the less likely side. If you're in between those two, it's uncertain whether you'll get access to this type of reporting or not, or whether you'll be up in Tier 2, which is what we currently have simplified disclosure arrangements. So if you're in that middle bit, I would hang out and really wait for that regulator updates or updates from Treasury around who gets to apply. So if you're doing special purpose at the moment, I would just hang out where you are, continue to do that until you've got certainty around which tier you will end up in. So what are the fundamentals, if you like? And I've pulled out some slides. These come from the AASB in one of their most recent updates that they did for us in another format. So I've pulled out slides from them. So these are cutouts of theirs. I'm just going to go through the key differences and some of the really key issues between Tier 3 and current accounting standards. So the first one is in relation to consolidation, related parties, those type of things. So consolidation will be a choice. So if you get to apply Tier 3, you can choose to consolidate, or you can choose to measure what's now going to be called notable relationships. And in that little green box is a definition of notable relationships. So it's still a power-based concept. Do you have power or ability to control, participate in operating policies, strategic decision-making, etc.? So it's really a simplified test, but it hangs on the same types of concepts. So if you've got those type of relationships, you can measure your investment, which may be zero. But if you've got actually investment, you measure it at cost or fair value or under an equity method. I don't think we'll see many doing equity. So you measure that, and you can choose to do, in effect, parent-only standalone financial statements, or you could choose to consolidate. So again, choice. At the Tier 2 level, you don't have such choice. If you meet the definitions of control, you will be into consolidation if you're in that tier. Secondly, and I guess flowing on or related to that, is if you do have an entity combination, and that's where you either take over another entity or take over a division or part of a business or activity of another entity. You do what you might think of as a merger. There's some simplification in that. Currently, you would book assets and liabilities at fair value, and you would see either typically a gain on acquisition or a loss on acquisition of those type of, when you get those types of transactions. Under Tier 3, you get to use a book value method. So you in effect just to pick up the carrying amounts that the subsidiary or the other entity were carrying their assets and liabilities at. So you can just measure employee entitlements based on the accounting standards. Likewise, if they had some land and buildings just carrying a cost, you could pick up that book value and it just becomes in effect your cost. So you get to simplify rather than going through. What the standard really requires is some detailed analysis around what are the fair values of all the assets and liabilities picked up. So shortcut, use book value methods, saves time, saves cost, reduces complexity. I would note that the difference between the net assets that you acquired and the consideration you paid usually would equal goodwill or a discount on acquisition, in effect revenue on acquisition. That is different. So now the formula for tier 3 will be you look at consideration paid, take off the net assets, and again, consideration paid could be zero if you're just merging an entity in, for example. The difference between that is the consideration paid and the net assets doesn't hit your profit and loss. There is no goodwill on those types of transactions under tier 3. There's simply an entry to equity. So there'll be this. So this is something that we don't see at all under current accounting concepts. There'll be an entry to where you increase or reduce your level of equity on consolidation/combination. So that's quite different. In relation to related parties and the disclosures, because of that concept of notable relationships, you will be look at whether you've got those notable relationships, where you do related party disclosures around relationships, transactions, the nature of the relationship, and then the transaction and balances. You'd be pretty used to that disclosure anyway. Under tier 2, some of the feedback around when the ACNC made related party disclosures mandatory even for special purpose reporters a couple of years back, where you've got there's no requirement for key management personnel disclosure. The assumption is that there's not going to be many key management personnel in smaller entities. There might only be 1 or 2 remunerated key management personnel. So there is no disclosure from that. And also there's limitations, or they've defined that you only need to disclose things like donations from key management personnel, related parties, board members. There's a higher level of threshold of materiality being applied around those types of donations give real influence over the entity's activities or resource use. That's a bit of a subjective test, but if it doesn't, then you don't have to disclose those type of related parties. So I think they've, again, taken a bit of a pragmatic response to some of the issues of related party disclosures that tier 2 have been experiencing over the last couple of years. Changes and errors. So typically we're under IFRS reporting. So ever since that came in way back in 2005, where you have change in accounting policy, errors, you do retrospective adjustments. So you go back and change your comparative period numbers. That's what that means. Where tier 3's a bit different. So where you've got an accounting estimate, the same as what you do now. So an estimate might be your leave entitlement provision, where there's estimation within that, for example. You just pick up the differences or those changes in estimates in the current period. So that's the same as tier 2 gets. Where you get to change where there's a change in accounting policy, for example, you go from cost to fair value, or the accounting standards change and the tier 3 accounting standard changes and introduces something different. That will be an opening balance adjustment in the current period, so an adjustment to your asset or net asset value or equity, and then you will just say, here's the accounting policy for last year, here's the accounting policy for this year, and you will just prospectively or apply it to the current period. Don't change the prior period numbers. However, if there's an error, so errors can occur because of fraud or other types of accounting errors that occur, that is a retrospective adjustment. So where you've just not applied the accounting requirements, made a mistake that's material, you restate the comparative, and that makes the comparative far more comparable and in line with the accounting policies. So that's where the board landed. There's a lot of debate around that area, but that's where the standard will go. A few more large differences. So impairment, if you're into the accounting standards for tier 2, you might know that impairment's all about recoverable amounts. That may be discounted cash flow type analysis, all those things. Tier 3 just gets some really simple tests. So you look at indicators. So is the asset damaged, spoiled, obsolete, or are you not going to use it based on your either strategy or decline in external demand or something like that? If that impacts, if those indicators are there, then you test impairment around your capacity to continue to earn revenue from those, or recoverable amount being what could you sell it for, and so you look at those tests. So it's really simplified reporting around that, and looking at those sort of triggers. Leases off the balance sheet. So we go back to where we were many years ago now, where leases, you expense leases on a straight line basis. There's not a, is it an operating lease? Is it a finance lease test? It's just if there's a lease expense, no recognition of a right of use asset or related lease liability. And concessionary leases, so where you've got peppercorn, something like that, you just treat them the same as other leases. So there's no complexity there. So I think that's a excellent reduction and just remove something from balance sheets that really I don't think was helping users of these financial statements, particularly at the smaller end of the not-for-profit space. Revenue, you notice that I talked about revenue earlier because it's complex. So the current standard, AASB 15, it's complex. Not-for-profit grant income particularly can be quite complex accounting for it. So there's been a real simplification in the revenue in what's proposed under Tier 3 for revenue recognition. The proposals are, or will be that, and the standard will be that the timing of revenue recognition is based on what the common understanding between the parties is for why the revenue was provided. So that could be sales revenue. If you're selling a good or service, you know, there's common understanding that I'm paying this amount of money to get this good or get this service. That's no different to what we'd see now. However, if I'm giving a grant to your organisation and that grant is clearly for, you know, I'm intending to give it for next year, you've given me a grant application, it's all based on budgets for next year and I've chosen to give you a grant. It's clear that that's for next year. We would then have common understanding and therefore you could defer revenue and therefore recognise it in the period that it related to, for example, without, you know, the whole concept of performance obligations and is there a customer and is it too external and when does goods or services transfer based on those performance obligations, etc. It's just common understanding. Common understanding will involve some sort of written, the standard does say oral, but it's difficult to justify oral when the auditor asks you or something like that. So written communication. And so it doesn't require enforceability, which is one of the concepts of AASB 15 at the moment. So revenue measurement is based on the amount you expect to receive. There's no financing and those sort of things, which is, you'd rarely see that. So I'll skip over that. So what does that mean? I think it means we're going to see some far more opportunity for deferral of revenue. The doors are really wide open as opposed to what AASB 15 has. And I think it gives you the ability to structure arrangements. So if for example, you do an appeal for a particular natural disaster or something like that, and I think where you've got a website and someone you do an appeal and someone gives to that specific appeal, which is for this particular, you know, to do certain things in relation to this natural disaster or whatever, we would then probably have common understanding. And so at the moment you treat that just as a donation, recognition on receipt. I think the opportunity is there to structure those type of appeals, to structure your communication with major donors, for example, to help you get to matching principle where AASB 15 didn't necessarily allow you to. So that's something worth thinking about as Tier 3 gets closer or you move towards adoption. Briefly on transition, so there's a lot going on in this slide. When you transition, you don't change comparatives. You just apply it to the opening balance. So you get this modified, what's called modified retrospective approach. and those sort of things, again, where you transition from tier 1 to tier 2. There is some disclosure relief around changes, that sort of thing. But there's also a few interesting opportunities, I think, in transition. I'll talk about these as tier 3 becomes open for adoption. But here's a list of them now. So you don't have to go back to previous revenue contracts. You can just look at new ones in effect, continue to do what you were doing. Same for financial instruments, that sort of thing. One really interesting one is this opportunity of deemed cost. And deemed cost was a concept when IFRS first, for those who are as old as me, when IFRS was first introduced, you got to, in effect, what your carrying values were for things like land and buildings became deemed cost. So there's some real opportunity. For example, if you're a charity, you've owned some property, you're under the cost model, you would actually like to be, record your property, for example, at fair value, but the auditors told you, well, you'll need to go and get a valuation. That's going to cost money. You need to do that every 3 to 5 years. So you've got this ongoing cost. And it's all a bit, you looked at cost benefit and went, actually, it doesn't really make a lot of sense. We'll just stick with cost. As tier 3 comes in, you probably get the opportunity to do a fair value adjustment in your current accounts under special purpose, in effect, move to fair value. And then on tier 3 adoption, that becomes deemed cost. So you get the one-off uplift in your balance sheet without the obligation to do ongoing revaluations and things like that. So that'll be something that, again, we'll be talking to our clients about as we get towards move towards adoption, around some of these potential opportunities for you to think about around financial reporting that makes sense to you and would be of benefit to you. So they're the main concepts within tier 3. What happens if you're above the tier 3 threshold? Well, unfortunately, that would mean you're going to be in general purpose tier 2. So you will have to apply revenue under AASB 15, leases on the balance sheet, consolidation will apply. So again, if you have power, ability to control an organisation, another entity, consolidation applies, and you would need to do full SDS, simplified disclosures. So what does that mean? I think if you're over 10 million, it's important that you start to think about those type of requirements and what that would mean to your financial statements. Do you need to do anything? Is there a lead time in relation to some of that or not? I think I'm going okay for time, so I'll just touch on a couple of those issues a bit more with a bit more emphasis. The first one is around control and consolidation. We see this as a really big issue in the charitable, not-for-profit space, particularly around some of the sort of religious based entities where there's a lot of entities, in particularly in denominational type groups, large church groups, that sort of thing. Lots of entities for a really good reason. Some of them around different tax statuses and all those things. So it's not, there's no criticism of that sort of structure, but realise there's complexity in that. We've got concerns, and I think some of you will have heard our concerns before around AASB 10. The Accounting Standards Board has certainly heard our concerns around that. They have done what's called a post-implementation review, but they've basically said they're doing ongoing research. They've made no adjustment to AASB 10, and there's no specific items flagged or alternative proposals at the moment. So we continue to express our concerns in that area every chance we get. So I would note that if you have control in a not-for-profit context, usually it's through either membership. So you might be the sole member, your entity might be the sole member, or your board are the sole members and the board of the subsidiary entity. And so that would, or you've got the ability, even if you don't use it, to appoint the majority of a board, which may be an historical setup thing in a constitution. Those type of arrangements would typically lead you to meet the definition of control under AASB 10, and therefore in future, if you're need to report you would be in consolidation. Regardless of there's a different charitable purpose, there's no financial returns between or transactions even between the two entities, doesn't matter. It's quite possible you're in control. If it doesn't make sense, what are some of the things you can start to think about? Now, changing constitutions, those sort of things can take a fair while. So I'm just going to give you a few ideas that you can think about if you think you might be in consolidation and it doesn't make sense to you. What some of the things you can do. Now, this is pretty general advice, so don't go off and rush off to this type of arrangement. Please come and have a discussion with us. You might want to involve a lawyer in changing constitution type considerations. But I would suggest you step back and consider, well, what were you really trying to achieve around being the member or having an ability to appoint the member of a board? So some of the options you could do would be looking to, can I still achieve those overall objectives, but reduce my level of power? What do I mean by that? So at the moment, if your entity has the ability to appoint the majority of board members, AASB 10 would say that gets you to power and likely gets you to ability to control another entity and therefore consolidation. However, there's an example where you only have veto rights. So you can veto the appointment, for example, of a proposed board member, but you can't appoint. That's a lower level or reduced level of power. And AASB 10 would say at the moment that you don't have the ability to control. So perhaps something like a veto right and then some conditions around who can be a board member. So for example, they've got to be a member of a particular denomination or church, to enable them to be on the board of a school, for example. So in effect, you get that, what might be considered some sort of ongoing faith alignment or values alignment. You have veto rights. Those type of options probably don't get you to the threshold of control, and therefore consolidation wouldn't apply. But maybe you've achieved very similar objectives to what the original constitution was established. So it's that type of arrangement. The second one, I've seen this a lot in the for-profit space over the years, would be to think about your structure a bit differently. So can you, in effect, get a parent entity or the top entity in a structure that either doesn't have to report or would have low level of income and therefore would get to adopt tier 3, where consolidation is a choice, and therefore not apply consolidation legitimately. So you'd end up with a structure that looks something like, this flat structure where the parent entity either doesn't have to report or doesn't have to consolidate because it's tier 3, and that group therefore would not have to consolidate. So again, I'm not advocating for necessarily, I don't think consolidation is a bad thing. I think it makes a lot of sense a lot of the time. So I'm not advocating for, this is your way to get out of consolidation and everyone should. I'm just letting you know that there are structuring and things you can think about, again, where I'd say where consolidation really doesn't make sense to the users, and that's because the users of different financial statements are very different, and therefore putting them together doesn't make sense for either of those. I think if that's your scenario, these are legitimate things to think about. Right, I'll leave Ed to answer all the tough questions around that one. I'll just jump on to sustainability, and then I think hopefully I'll be able to finish up a little bit early and give you a lunch break. So where are we at with sustainability? So sustainability reporting applies to entities that report under Chapter 2M of the Corps Act. If you're an ACNC charity, you do not report under the Corps Act, you report under the ACNC Act. However, if you're a for-profit who has to lodge accounts with ASIC, or you're a not-for-profit, again, sort of sporting organisations, company limited by guarantee, some member-based organisations, they have to report to ASIC because they don't meet the definitions of the charity categories under the ACNC. So if you're one of those entities and you're within this table of thresholds, at the moment, you're going to be, or as the legislation stands at the moment, will be required to implement sustainability reporting. So if you look at the top line, I don't think we've got anyone on this call that would be a tier 1 group. If you are, you've got some rapid work to do. But what you see is their financial reporting period beginning 1 January 2025. So the December 2025 reporters who meet those thresholds of the top line there, they will do sustainability reporting in 31 December 2025. What this means, typically there's going to be listed entities and some other really large private companies that report. What this means is those type of entities will then be on the public record come Feb, March next year, and we'll get a really good practical look around sustainability reporting under the new standards in the Australian context. So I think that will be really helpful for us to all see some really good examples of sustainability reporting that have also been subject to assurance. So auditors are starting to look at those. It's a lower level of assurance. It's not the full disclosures yet, but it will give us a really clear understanding of the length, nature of some of the disclosures, which I'll touch on in a minute. So most organisations below that threshold, even if they've made a bit of a start, are waiting to get a good look at a whole lot of other reporters. And then at June, basically a whole chunk of other listed entities will report as well. So that gives everyone else a bit of a head start and a bit of understanding in that space. So again, just want to let you know, exemptions. So again, ACNC registered, you're exempt. If you have a class order exemption, I won't go through the list of those. If you have them, you probably know, so I'll just leave it at that. You also, if you're exempt from lodging financial reports, you'll also be exempt from sustainability reporting. I do note that Group 3, so if I go back to this bottom group, there is this concept of if you don't have material risk and opportunities in relation to sustainability reporting, or sustainability or climate risk, in effect climate risk, then you don't have to do full reporting. You just have to make that disclosure. Now that's still subject. Your auditor needs to agree with that assessment, and there'll still be a process to go through to get to that. But there's uncertainty around how many organisations and what type of organisations will get to apply that exemption. So hopefully we start to get some really clear understanding over the next couple of years around that. Sustainability reporting. So what is it? I probably should have said right at the beginning, sustainability reporting in Australia is really greenhouse gas, climate related sustainability only questions. It's not about biodiversity. It's not about using less resources, environmental type reporting that the more broader ESG type reporting would typically encompass. It is purely around climate. There's 4 pillars which are sort of divided up on the right-hand side there that the climate statements or the sustainability report will need to cover. So they cover governance, strategy, climate-related risks and opportunities, and then metrics and targets divided up into what's called Scope 1, 2, and 3 emissions. Scope 1 emissions are where you, in effect, burn a greenhouse gas at the moment. So I think you've got a fleet of cars and you're putting petrol in them. Scope 2 emissions are your direct electricity use. And Scope 3 emissions are your upstream and what's called your upstream and downstream emissions from your goods or services you supply to customers, but also the inputs that you receive from employees and suppliers as well go into that Group 3 or Scope 3 emissions. The statements will also have notes to them explaining the basis for the calculations, etc., along with the Director's Declaration. So because I don't think we've got the large end reporters, I'm going to leave it there. As we get closer to particularly Group 3 reporters, we will give you some far more information. Obviously, clients that we're aware of that will be in that space. We've already started to suggest some things around what would be the next steps or first steps around sort of getting your head around what this might look like. Obviously, we'll continue those discussions with you over the next year or two as well to help you get ready. Just in relation to, so I've already talked about first year reporters about to happen. I note that the Ethical Standards Board, so around things like independence, the Auditing Standards Board, they're still releasing guidance, amendments, etc. in this space because it's happened really fast. So it is a bit of a moving feast still at the moment. But I also would note that auditor independence, the principle that an auditor can't audit their own work will apply to sustainability reporting. So your auditor cannot come in and do a lot of this work. We can point you in the right direction, refer you to others, etc., but we can't write your sustainability report for you and then audit it. So it is something that you at an organisation level will need to take control of. So that really completes the presentation. So I might just stop sharing maybe, and hopefully I might be able to see some of you. I'll just grab you onto my screen properly. Most of you have got your cameras off, which is fine. I might just check in with Edward to see whether there's any questions that we need to cover. Otherwise, I'm almost up to my time. So Ed, were there any other questions? Jump on if there were.
Hi, Jeff, and hi to everyone out there. Yeah, we just had a couple of questions. I've provided some comments, but happy to just do a quick recap. There was a question around the ACNC financial statement reviews and whether they gave examples of errors in KMP reporting. So they did on that one, and I've provided a link to the ACNC's on that. They provide some interesting comments around, in particular, to do with the AIS entries and so forth, and the consistency of information. And some of the other areas as well is definitely worth a read if you are completing an annual information statement, because it does point out to some of the common errors of things that people haven't been checking in enough detail. There was another question around not-for-profits who are currently general purpose financial reporters and the application of tiers. The principle is has historically been with the AASB that if you can report at the tier you're required to, or you can report at a higher tier, but generally not a lower tier. And I'm not aware of any instances where if you were in tier 3, you would be mandated to do that. I believe you'd still have the option, we would expect, to report at a higher tier.
You can opt in, sorry, and that's a great question. You can opt in to tier 2, similar to that. You can opt into tier 1. So tier 1 is full compliance, not simplified disclosure, full compliance with accounting standards. You can opt up. You can't, as Edward said, opt down. However, you can move down on, and I think hopefully that transition slide talked a little bit about that. It was a bit wordy, but if you're currently doing tier 2, in effect tier 2 SDS, but you're within the tier 3 thresholds, and again, you'd only do it if you're not likely to jump back up to tier 2 threshold or be outside those thresholds in the next year or two, you can then on transition go adopt tier 3, which is more simplified. So you can move down to tier 3 where you meet the threshold criteria that'll be established, or you can continue to do tier 2. If that works for you, you think it's better reporting for whatever reason, tier 2 is still available.
There was one other question that just came up. It's probably a more detailed question, but there is a short answer to it, I believe, and it's just in relation to consolidation. And the question is, it sounds like even if there is no possibility of distributions of profit or proceeds on any wind-up, consolidation is still a possibility under AASB 10 if an entity has control by way of appointing a majority of the board, because returns are defined broadly. And in terms of that not-for-profit returns, which are not necessarily financial.
Yeah, absolutely. And that's part of the real complexity of that standard, where historic arrangements, historic constitutions can result in control, even though it's actually not exercised or operationalized. Maybe in any way, you would still likely get there under AASB 10, but that is a bit of a complex area. So if you've got a specific question around that, I'd suggest you ask. If you're our client, please get in contact with me or your your relevant partner manager around that specific question, or you can ask your auditor, or you're welcome to come to us and ask us a tech-based question if you want us to do some analysis of that specifically for you.
Jeff, and that was all for the questions.
Perfect. Thanks, Edward. So I'm right on time for 1 o'clock, which is excellent for me. Usually I'm racing. Again, I hope you got something out of that. Please, if you have any other questions, please don't hesitate to reach out. But otherwise, thank you very much for joining. And as I said originally, hope you all have a Merry Christmas and a Happy New Year, and hopefully get a break. Even the December reporters on the call today, at least get a bit of holidays before you're back answering auditor questions and things like that. But otherwise, thanks very much for joining us, and have a good day.